This is the Asia Trade. I'm Avril Hong in Singapore.
And I'm Annabelle Droulers in Hong Kong. The top stories this hour. A flat lead-in for Asia as the US stock rally wavers amid signs of buyer exhaustion. Gold and silver coming off their steepest losses in years, with investors locking in profits after historic surges. President Trump adding to the uncertainty by casting doubts on upcoming talks with the leaders of Russia and China. Also ahead, the challenges facing Japan's first female Prime Minister and her cabinet as Takaichi seeks to turn around her party's fortunes. Plus, we get the outlook for lithium with the CEO of Australia's biggest pure play producer, PLS, as the US and Australia strike a deal on critical minerals.
And in terms of the markets, we saw how that risk rally took a breather amid those signs that you speak of, Bell, of buyer exhaustion. The S&P 500 closed flat after hours. We will be keeping tabs on the stock of Alphabet after sources told Bloomberg that, along with Anthropic, Google could be in talks for cloud computing deal that could be worth in the high tens of billions of dollars. Other than that, we are still seeing U.S. crude futures coming below the $60 handle. It's got a demand problem, obviously, but given how prices have been coming under pressure, the Trump administration has been taking that opportunity to refill the strategic petroleum reserves. We have also heard how Trump reiterated that India will be winding down a little bit its purchases of Russian crude. Now, we are seeing treasuries on the yield on the 10-year still hovering below the 4% handle. So as we see flip the board, this everything rally that people really had doubts about reversing, treasuries have been doing well. Worth noting what we saw in gold, because that decline intraday was the steepest in more than a decade. I think it was about 12 years. So doubts that had been cast about the so-called everything rally, we're certainly seeing those technical indicators that have been looking overstretched playing out in the session as well. Belle.
Yeah, and I think, Avril, just these concerns as well, the huge rallies we've seen in gold and silver, were they just starting to look a little bit overvalued, and are investors looking to take profit as well? In the session today, it's going to be the really big theme actually for us, especially when you've got a lot of those miners that are listed in Australia. You can see here the materials index, where a lot of those miners are listed. That sub-index is well outpacing those losses we see for the broader ASX 200. But as you said, we've got that lead in from the US, pretty much flat into the close. That in combined with those moves in the dollar, we saw some dollar strength. We saw the moves in treasuries, oil as well, a slight strengthening. These are all negatives for Asian equities as well. And you can see that we are setting up for perhaps some mixed moves at the open here.
And another potential negative, I guess, Belle, is comments from President Trump. He is casting doubt on whether his anticipated meeting with the Chinese President Xi Jinping will happen later this month. Trump also says that without a deal, Chinese imports will face a tariff of about 155% as of November 1st.
Right now, as of November 1st, China will have about 155% tariff put on it. And I don't think it's sustainable for them, so I want to be nice to China. But China's been very rough with us over the years.
Let's bring in Bloomberg senior editor Derek Wallbang. So, Derek, maybe this is typical Trump. He does reiterate, though, that he has a good relationship with the Chinese president. But why do you think he's couching things in this manner about a potential meeting?
Well, Avril, I think, look, I agree with you. I read into this on a top-line level that Donald Trump is still positive about the idea of a meeting. He's still positive about the idea of a potential outcome. He said, quote, "I have a great relationship with President Xi. I expect to be able to make a good deal with him." And that is really important language from the president. That having been said, we have talked so many times in the last couple of weeks about how this relationship keeps getting added layer and layer and layer and layer of things that both countries now need to unwind if they're going to have a positive deal, right? Even if we're going to get a deal that just takes us back a couple of weeks to where we are, or to where we were. And layered over all of this is that threat of an additional 100 percentage point tariff for Chinese imports or exports into the United States. And so that's a really big sort of thing there. It is a really consequential meeting. So far, I would say, if we're looking at vibes, we're in happy talk right now, but there's an awful lot of uncertainty here. I do think, specific to your question, that you're seeing a president who does not want to lock himself up into the idea of having to make a deal, the idea that no deal is bad and that any deal is better than no deal. I think Trump very much is saying, I think we can make a deal. I'd like to make the right deal, but he's giving himself space to walk away if none is presented, in which case a whole manner of things that the markets are currently not pricing in may come to pass.
What about what we're expecting around President Trump meeting with Russia's President Vladimir Putin? Because this, again, has seemed to be quite a sharp shift away from what we were hearing just a few days ago.
Well, Belle, I think the volatility in this relationship is exceptional, right? We have gone from the two meeting in Alaska to Trump being really disappointed at Russia's follow through there and talking about sending, advanced U.S. Weaponry to Ukraine, then coming back a little bit to saying with Zelensky that the two sides just need to quit now and freeze around where the battle lines are right now, to Russia again saying that that's probably not what they're looking to do. And so I think that you're seeing this sort of whip cycle of Trump thinking that a deal is close, thinking that a deal is at hand, or maybe projecting that, and then Russia saying that it doesn't want to insert that thing here. And there is a bit of a whiplash effect. But look, Trump, I think, was signaling to Russia that he does not want, as he put it, a, quote, wasted meeting with Vladimir Putin, perhaps signaling some frustration over the Alaska summit that did not pan into a peace deal he once promised was going to be easy.
Derek, thank you for bringing us the latest. Bloomberg senior editor Derek Wallbank. Now, as we wait to see how world leaders engage with the U.S. president, among them, Sanae Takaichi, this will be among her immediate priorities. She has, of course, broken through Japan's glass ceiling and become the country's first female prime minister. Her ability to build a lasting legacy will depend on her capacity to restore the fortunes of a ruling party in disarray after decades of dominance. Let's bring in economy and government reporter Erika Yokoyama. Erika, so we're seeing Japanese politics in some way moving past deadlock. What are the challenges that lie ahead?
Sure. So Takaichi's appointment as a prime minister, I think that's at least make a step forward for the Japanese politics, which has been totally turmoil over the past few weeks. I think it was pretty impressive, to be honest, how Takaichi navigated this political storm so skillfully. Because, within just over a week after ending a 26-year partnership with Komeito, she secured a backing from Issel to become our prime minister. So I think that's a dramatic success story in itself. However, as you said, her challenges is far from over. U.S. President Trump is expected to visit Japan next week, and she must prepare carefully for their first meeting, where trade deals or defense spending could be one of their key agenda. And she also needs to move on quickly on economic package and extra budget to finance that. And that would not be an easy task because, she needs to accommodate the demands of the new coalition partner Issel as well as the other stakeholders.
She has moved pretty quickly to appoint cabinet members as well. So what does that look like?
Sure. So yesterday, Takaichi appointed 18 cabinet members to work with her, with some of them being quite high-profile figures. That includes Shinjiro Koizumi as a defense minister, Motegi as foreign ministers, and trade negotiator Akazawa as the economic minister. And most notably, Takaichi appointed Satsuki Katayama as Japan's first female finance minister. I feel like my impression my impression so far is that members of Takaichi cabinet are more outspoken than those under the previous Ishiba administration. Even before official inauguration, they already spoke to reporters about their personal political stance. For example, Katayama told reporter yesterday briefly her views on fiscal policy, currency, and other things, while her remarks were not hugely so far deviating from what her predecessors said, but they already hinted that she may favor more fiscal spending than the former finance minister.
Speaking about being outspoken on policy, where does this leave monetary policy? Because we know how Takaichi has walked back some of those comments surrounding the BOJ. How will her appointment affect the central bank's rate hike path?
Actually, some BOJ watchers believe that the central bank is unlikely to move immediately following Takaichi's appointment. Like BOJ and government previously had some clashes over the rate hike path, so some think that the BOJ may choose to wait and avoid political friction. So far, though, Takaichi has been quite cautious about BOJ this time. At her press conferences last night, she said monetary policy should be left to the BOJ, so she may want to avoid jolting the market while facing tough challenges both at home and abroad. And on the BOJ side, people familiar with the matter said that there is little urgency to move now and raise interest rates. So they believe the economy is on track toward achieving their price target, allowing the bank to wait and monitor incoming data. And trade data, inflation data is coming soon, so the market should be watching them closely.
Erica, thanks for your time this morning. That was our Bloomberg economy and government reporter, Erica Yokoyama there. And taking us back to Sydney now, because there's really a very clear theme that's developing here, because we've seen that big sell-off in gold and silver overnight. Off the back of that this morning, we're seeing Aussie gold miners or precious metal stocks that are getting absolutely hit. We've got the broader metals gauge outpacing significantly the losses we see for the ASX 200 this morning. But just to recap the biggest details here, gold and silver both seeing their steepest declines in years. Investors do appear to be locking in profits because they may be concerned that the historic rally that we've seen for both of those assets is leaving them looking a little bit overvalued. So we'll get more details on that ahead. This is the Asia Trade, and you're watching Bloomberg. You're taking a look here this morning at the Chinex over in Shenzhen. This is often seen as China's answer essentially to the Nasdaq. It had a strong performance on Tuesday, a lot to do as well with what you can see there, those CATL shares as well, because we had that company. It makes up around 20% of the index, but posting results that were pretty much in line with estimates and a constructive outlook for 2026 as well. So let's discuss what this means for lithium demand overall, given that CATL is the biggest EV battery maker in the world. So we're joined this morning by the PLS Managing Director and CEO Dale Henderson. This is Australia's biggest pure play lithium producer. So Dale, we can touch on CATL's results and what it means for lithium demand in a moment, but generally, how are you gauging price dynamics and demand in the lithium market right now?
Sure. So, look, thanks very much. As it relates to demand globally, it's very, very positive as it relates to, of course, EVs being a key growth set. We've seen for the September quarter about a 20% increase year on year, so that's pretty remarkable. Outside of that, BESS, or battery energy storage, is growing in leaps and bounds. So year to date, it's almost 40% growth on the prior year. So some very, very strong structural growth drivers. And then outside of that, we're seeing some strong green shoots. So in particular, the data center investment's pretty phenomenal. And connected to that, we're expecting more battery support. So demand's looking very, very good long term.
Are there any sort of risks maybe to that outlook? I'm thinking, for instance, recently we saw China approving CATL mine reserves in China, for instance. That played into prices, but what does it mean for overall demand and supply?
Sure. So as it relates to the demand side, as I mentioned, those structural growth drivers look incredibly positive, and that's sort of driven through three sort of key drivers, being obviously energy transition, in particular around solar adoption. Then you've got the swap out of products, so combustion cars for EVs. And then you've got these green shoots around new products, whether it's EV tolls or other applications. So those are the broad demand drivers. As it relates to the supply chain build out to support that demand, well, there's a lot going on. So we've seen sort of defensive measures that you mentioned there from China. Outside of that, you also sort of see subsidies and other support regimes from other countries. And then, of course, we've got the recent news we had yesterday of the collaboration between the US and Australian government. So all of that is happening at the same time to build out these supply chains for these future-facing industries. So there's a lot going on.
There is a lot going on, but also aware of the fact that decarbonization might not so much be a priority for the US given the shift in policies there. Do you see there being an impact on demand via EVs and in turn lithium?
Yeah, so as it relates to global demand for lithium, that's looking very positive as per the stats I mentioned a moment ago. Zooming in on the US, as it relates to the demand specifically from the US, well, as it relates to EVs, we have seen a pullback, but I'd highlight that EV demand through the US was roughly 10% of the demand stack for EVs. So it's a really important future market, being it's the second largest auto market globally, but it's a small component of actual demand to date. But outside of EVs, the BESS demand set for the US is actually growing very strongly. And that's no surprise when we look at the investment in data centres. And I note that globally, McKinsey's estimating something like $7 trillion to be invested globally for data centres within this decade. So that's a remarkable level of investment. And coupled with that, of course, well, batteries are being deployed to support the stability of those data centres. So although for the US we might be seeing a pullback in EVs, it looks to be supported by, as I say, this BESS subset. But as I say, this is a global shift. And the shift is not just about green energy, it's actually because it makes commercial sense. So hence we're seeing these strong growth data across the board.
Dale, I wonder also if you could weigh in on, okay, longer term, the trajectory looks quite solid in your mind on lithium demand, but we are expecting a fair bit of volatility as well. Do you think that in that sense, miners should be getting more into futures to hedge against some of that?
Yeah, so as it relates to the volatility, well, the lithium market has been very much volatile from inception, and that's largely owed to the immaturity of the market and the fact that it's growing rapidly from a very small base. So out of that, yes, we've seen some very high highs and some very low lows. However, over time, I anticipate that will start to even out as more scale enters the industry. Plus, the other thing which will ultimately help in time will be the emergence of a more efficient spot trading mechanism, coupled with more futures exchange options, which to date are very nascent. And to your question, well, there's actually limited opportunity to hedge, albeit more instruments are starting to emerge. So what does that mean for upstream miners like ourselves? It's really a case of setting the business up to withstand this volatility, which of course is what we've done at PLS.
Do you think then as a business you would be interested in increasing more of your sales then through the spot market instead of term contracts? And do you think that spot sales is maybe a better idea going forward to take advantage of those swings that you were talking about in the market as well?
Yeah, great question. In this regard, we've taken a portfolio approach to our sales strategy. What that means is a combination of a smaller component of spot sales to help with price discovery. That's important not only for our business but for the industry. So we do that, whilst on the other hand, we sort of set aside a large proportion of our sales committed on medium and long-term offtakes. Now, through that combination, we believe we get the best of both worlds, price discovery plus certainty through partnerships with those strong supply chain participants.
You mentioned as well, of course, this deal that was inked between Australia and the US for critical minerals. Do you as a company expect to receive any direct funding? We saw that yesterday as well for some companies being announced.
Look, it's too early to say, but as to this initiative of the Australian and US government, very, very positive. This is the types of initiatives we need to see to build out these supply chains for the world because as I mentioned earlier, it's growing from a very small base. Much more needs to be built out. These are global, future-facing industries, so it needs this type of support. So we're very positive on this step, and we're looking forward to seeing more details in time.
Dale, great to chat. Thanks so much for your time this morning. Dale Henderson, Managing Director and CEO of PLS. We have more ahead on the Asia trade. This is Bloomberg.
Well, Bloomberg's learned that Anthropic is in talks with Alphabet about a deal for cloud computing power that could be valued in the high tens of billions of dollars. After hours reaction you're seeing there, Alphabet is climbing. Amazon, which is actually an Anthropic investor, is slipping there, you can see. But let's bring in our AI reporter, Shery Ghaffari in San Francisco for more. So, Shery, thanks very much for your time this morning. And let's just get started with the contours. The talks are in their early stages, we understand. But what have we learned so far?
That's right. So we know that Anthropic is in talks to expand its compute capacity with Google at a value of high tens of billions of dollars in compute.
What is this ultimately going to mean for Google? I mean, there's been some indication that this could mean OpenAI is the LLM, or rather that Anthropic is going to be the LLM rather than Google Gemini.
Yeah, so Anthropic, which is, an OpenAI rival, they're also in the business of making LLMs or foundational AI models. And Anthropic has historically partnered with both Amazon and Google for its compute capacity. Now, Google uses TPU chips. Amazon has a Trainium chip. So they also have these companies, these big tech companies that Anthropic partners with, have their own chips, in addition to the NVIDIA GPUs that are very commonly used as well, right, in training and running large AI models. So this is sort of an example of Anthropic deepening its partnership potentially here with a major player. And it's coming at the same time that we're seeing its rival OpenAI also forge a bunch of partnerships with chip makers, with hyperscalers. So we're just seeing this race to sort of secure compute across the board in the industry right now.
Shery, thanks very much on the latest on this Bloomberg scoop on the deal between Anthropic as well as Google potentially. Bloomberg AI reporter Shery Ghaffari for us there. Now, of course, also watching shares of Alphabet in the after hours, but we did see that risk rally overnight taking a breather with the S&P 500 finishing flat, and across assets, the dollar is looking quite flat at the moment. Worth noting what we're seeing in U.S. Treasuries, that yield on the 10-year still below the 4% handle. We have more ahead on the Asia trade. This is Bloomberg. Taking a look at gold stocks in Australia, they're getting really hard hit, tracking the declines we've been seeing in the precious metal. After intraday, at one point, it actually fell by the most in more than a decade. Now, for more on markets, let's bring in Bloomberg MLAC strategist Mark Cranfield. So, Mark, this is something you had been warning about weeks ago, as we saw, along with the risk rally in stocks, gold surging ahead. Now that positioning risk has come home to roost in a way.
Yeah, I mean, you can't continue in the way that gold was going. No market can go up in a straight line forever, and it was several weeks in a row gold was climbing. In fact, the warning signals really were the speed with which it was going from one milestone to another. So the speed with which it went from 3,000 to 4,000 was much quicker than it went from 2,000 to 3,000. And by compressing that timeline, you can tell that a lot of money is coming in. They're very speculative money, people who would be considered to be weak hands in the terms of the investment community. So they're the kind of people who would flee at the first signals. Also, if you look at what's happening in the ETF world as well, you could tell that the retail participation was really getting a bit ridiculous. And again, warning signals there. People queuing up at gold shops to buy the metal as well. Again, a sign that things are really getting overdone. Now, the risk here for markets is that because so much money has accumulated in gold position, it now needs to go other places. And clearly one of the most likely is US Treasuries. They seem to be acting as the haven of choice. To some extent, the Swiss franc, but that's closely tied to gold as well. So it's probably going to be US Treasuries which benefit the most as money floods out of gold and silver.
Yeah, and we did see that move in treasuries overnight as well, to your point there, Mark. What, though, I'm wondering, of course, nothing moves in a straight line. Do we see then a recovery in price? Because I think still names like Goldman Sachs, for instance, are forecasting 4,900 an ounce by the end of next year.
It will probably need to see a pretty severe correction here. I don't think it'll be too surprising to people if gold has peaked for this year. Going into 2026 may be a different story. By then, interest rates in the US, I mean, they're forecast to go down to about 3% for short-term interest rates. We've got 4 interest rate cuts priced in by traders for the Federal Reserve. So if we get to short-term rates another 100 basis points lower than where they are today, that will weaken the US dollar, that will help gold, silver, other things as well. But we're looking way probably into the middle of 2026. In the meantime, a lot of heat has to come out of the gold and silver rally, and to some extent the cryptocurrencies as well. That most likely is going to bring gold down to a lower level first. So I think most investors will be looking at this and saying it's pretty unlikely that gold will go any higher before year end. Where it goes in the first part of next year, that could be a different story.
Not forgetting as well that we're still in the midst of a U.S. government shutdown. We are expecting U.S. CPI numbers later in the week, but what do those risks present for the markets?
Well, the CPI numbers in themselves are probably going to be overlooked. There'll be a knee-jerk reaction if the numbers come out on the hot side. That's the where the market is susceptible, is that a CPI number which comes out higher than expected. People have been watching inflation come down comfortably. They would be a bit surprised. But in the context that we have very little other data, we've been deprived of most of the usual data. So if you have one piece of inflation data which stands out when you have nothing else, people are probably going to say, well, I want to see the rest of the picture. This is only a small part of the overall frame. And at the same time, the Federal Reserve have made it pretty clear that they're giving much more weight to the employment data than they are to the inflation data. So really, any signs of whether there's more weakening in the jobs market or any recovery there. But from what the sound bites we've heard recently from Federal Reserve speakers is that they see probably a bit more weakness in the employment situation than is actually showing up in the last bits of data we had. So from that point of view, this inflation reading probably is a bit less significant than it usually would be.
All right, Mark, thanks very much for joining us. That was our MLive strategist, Mark Granfield, there. And let's shift as well to another big mover in after hours, because we're watching Netflix shares here. You can see dropping in extended trading. That's after their third quarter results missed forecasts from both analysts and the company itself. And that was largely seen as due to a tax dispute with Brazil. But let's bring in Chris Palmieri, who joins us from Los Angeles. He leads our media and entertainment coverage. And clearly it seems this fine sort of overshadowed what many thought was going to be a pretty strong quarter from Netflix, Chris.
Yeah, and in fact, that earnings number aside, everything was strong, double digits. They've, reiterated guidance that's pretty strong for the year. But, in a stock like this that's had a pretty good run up already, any kind of bad news is looked at pretty badly by investors.
So this is seen as a sort of blip. What is the strategy going forward for Netflix on growth?
Well, they've implemented a lot of things. Number one, of course, this is just an incredible pipeline of movies and TV shows. They talked about K-pop Demon Hunters. What came out in the quarter has been the most watched movie in Netflix history, and a whole bunch more coming up in the fourth quarter. They've also been taking initiatives to drive revenue, introducing advertising, which some analysts have projected could double this year and next. And they've also cracked down more recently on password sharing, which has boosted subscriptions.
Investors still have been quite worried, though, that Netflix customers or consumers aren't increasing the amount of time that they're spending on Netflix, and you're seeing a lot that are still going to the likes of YouTube, for instance. What do we learn on that front?
Well, the company's executives on their call today did, emphasize that they're seeing really strong engagement across, highlighting some of the numbers like K-pop, Demon Hunters. But it is, without a doubt, I mean, the fastest growing services are these free ones like YouTube and Tubi, in that where people can watch content and not have to pay a monthly subscription.
One story we did as well had, and that was a Bloomberg scoop, but it was flagged during this call as well, just the possibility of M&A activity. But we were reporting maybe it could be some assets owned by Warner Brothers. So what do we know about that as well?
Discussion of that on the call, but both of the co-CEOs, they said they always look at things. They made it clear, not interested in any kind of legacy cable TV networks like the kind that Warner Brothers has. But if there was an opportunity that fit their overall plans, they would do it. And we indeed reported that they're considering an offer for the Warner Brothers studios.
Yeah, Netflix also saying on the call it'll be focused on growing organically. It'll be choosy in deals. Chris, thanks for bringing us the latest on all that. Bloomberg's Chris Palmieri in Los Angeles for us now. More earnings from the corporate front as well. Texas Instruments shares fell in late trading after it issued a tepid forecast for the current period, adding to concerns that the chip industry's recovery is slowing. The biggest maker of analog chips expects revenue of around $4.2 billion to $4.6 billion in the fourth quarter. The outlook suggests that customers are slowing orders as they navigate mounting trade tensions and a shaky economy. L'Oreal ADRs fell after disappointing sales growth in the last quarter as weakness in the U.S. outweighed signs of improvement in China. A pickup in demand for high-end beauty products on mainland China helped lift sales by 4.2%, but analysts had expected a gain of almost 5%. Hartmut posted strong revenue growth in the third quarter, driven by its popular Labubu dolls. Sales jumped as much as 250% from a year ago. The company launched new mini Labubus in late August, which sparked a fresh buying frenzy. Sales in overseas markets surged 370% compared to around 190% growth in mainland China. And General Motors shares jumped the most in 5 years after the automaker raised its profit guidance on strong truck sales and tariff relief. This comes 6 months after GM pulled its full-year forecast over tariff uncertainty. Shares surged 15% to close at a record high. CEO Mary Barra thanked President Trump for extending a tariff discount through 2030 on some auto-related imports. We'll have more ahead on the Asia trade. This is Bloomberg.
Sanae Takaichi has become Japan's first female prime minister, securing a parliamentary vote after weeks of negotiations with opposition parties to form a coalition. The Asia Trade co-anchor Shery takes a closer look at Japan's new leader and the challenges ahead.
Elected as head of the ruling Liberal Democratic Party in early October, Sanae Takaichi was a protege of the late Prime Minister Shinzo Abe. Seen as politically right-wing, a supporter of fiscal stimulus and a foreign policy hawk, she has touted conservative values on issues such as women's rights. Offstage, she's known to play the drums and for being a fan of heavy metal music and Margaret Thatcher. Her LDP leadership got off to a rocky start after coalition partner Komeito quit the 26-year alliance, forcing Takaichi to strike a deal with the Japan Innovation Party, the third largest bloc in the lower house. Even with this new coalition, challenges loom. Takaichi must reunite the party and re-engage with voters flocking to smaller populist groups. Japan is also grappling with rising costs of living and challenges with its migrant population.
There is a concern over the Japanese people with the too much concentration of the foreign people in certain areas.
Markets are embracing the so-called Takaichi trade, pricing in larger fiscal deficits and heavier JGB issuance. Takaichi is expected to meet with President Trump in the coming days and attend both the APEC and the ASEAN summits in Asia. As she steps onto the world stage while also facing daunting domestic challenges, the focus will be on how she handles the pressure. Shery, Bloomberg, Tokyo.
Now, after her win, Takaichi used cabinet appointments to shore up her leadership by handing out key roles to party rivals. Shinjiro Koizumi, the man she narrowly beat to become ruling party leader, was named defense minister, while Toshimitsu Motegi was given the role of foreign minister. Let's get more with Rintaro Nishimura, senior associate for the Japan practice at the Asia Group. Great to see you, Rintaro. So first off, we are seeing her appointing party rivals in order to secure her leadership in some ways. What do you make of her strategy so far?
First of all, thank you for having me. I think this is a sign of the reality in the Liberal Democratic Party where any new leader, as we've seen also with Shigeru Ishiba, has to sort of balance out the power dynamics within the party. And for Takaichi, who won this election, not in an outright majority, but in a contest, has to try and keep unity within the party by bringing in her rivals. She named two of her rivals in the, or three of the rivals in the cabinet, and also had her other rival, Takayuki Kobayashi, in her party leadership lineup. So clearly this is a sign that she is not on solid foundations and has to balance out relations with different parts of the party.
So there could be a lot of negotiation, maybe horse trading. What is that going to mean for policy making under her administration? And does that affect the expectation that we will see expansionary fiscal policies?
I think to an extent it might be unavoidable at the beginning, at least, to see certain stimulus happening because of the need for inflation relief measures. The Diet will discuss and deliberate on a fiscal year 2025 supplemental budget in order to finance the inflation relief measures. And because the LDP and the Japan Innovation Party do not have an outright majority in both houses, they would need to work with the opposition parties. And naturally, that would require a lot of compromise and probably more spending along the lines of what opposition parties want. And so in that sense, there will be, I think, initially a boost in spending. But Takaichi has mentioned a key word, which is proactive but responsible fiscal spending. So despite this notion that she is a pro-spending lawmaker, she is definitely going to have to keep in mind the debt ratio and other factors that will, to a certain extent, constrain her ability to spend government budget.
Yeah, as you said, the partnership that the LDP has with Issel isn't really like the coalition that they had with Komeito. So what's that process of trust building going to look like, and how long do you think it will take as well?
Well, I think the first big test will be this extraordinary Diet session that started this week. Issel has been quite clear that they are not going to jump into a straight coalition like Komeito, and that this would be more of a confidence and supply agreement in which they would vote for the LDP or Takaichi in no confidence motions and on the budget, but on bills, on individual legislation, that's a different story. So essentially, Takaichi will have to negotiate with Issel and also with other opposition parties to pass legislation. And so in that sense, the trust building will take some time. And I think at least until next year's budget is passed in March, I think Issel will be monitoring to see if the policy agreement that the two parties signed on Monday is carried out. And there are a couple of non-negotiables that Issel has mentioned, such as the second capital initiative, reducing social insurance fees, and also reducing the number of diet members by 10%, which all of these are going to be some challenging issues that other opposition parties will not want to go forward with. So this is a tough kind of environment for Takaichi to be in, but this is where her leadership will really be put to the test.
Yeah, there's certainly a lot of different areas still to be worked out between Issel and the LDP. Both of these parties, though, are perceived as being more right-leaning. Does that also create a barrier for them or an obstacle to deal with other parties in Parliament when they're trying to also pass any measures around social security or cost of living issues, for instance?
I think that could play a factor in some parties outright just opposing anything the LDP and Issel does. There's already been a lot of noise around both parties' desire to amend the constitution and insert the Japan Self-Defense Forces name into the constitution. There's also talks of completely overhauling the defense export rules that currently permit only 5 categories of exports. So there's clear moves already and a sense that this new government arrangement will be much more conservative and also hawkish on defense and security policy. And that could affect how certain parties vote in the Diet. But at the same time, because the minority government is only a few seats shy of the majority line, there are a couple of small conservative parties and also independents who might be actually more willing to work with a government that's willing to go beyond what the LDP was able to do with a party like Komeito.
Yeah, an early test, of course, is going to be President Trump's visit to Japan next week. That was Rintaro Nishimura, their senior associate for the Japan practice at the Asia Group. We'll have more ahead on the Asia trade. This is Bloomberg.
And we have data crossing the terminal out of Japan. The September trade numbers are in. Exports overall rising 4.2%. This is slightly weaker than the consensus estimate, but does mark the first rise in 5 months against the backdrop of lowered auto tariffs that might be easing concerns over trade tensions. It was, of course, lowered to 15% from 27.5% in mid-September, as promised in a July trade deal with the U.S. In terms of the Japanese exports to the U.S., it did fall on year by about 13%. In terms of what we're seeing in the trade balance, it's a deficit of 234.6 yen. Belle?
Yeah, and let's stay with Japan because the New York-based buyout firm KKR is ramping up in the country, deploying capital at 5 times the pace of a decade ago. Tokyo is now the firm's most active investment destination outside the US and its largest Asian market. Speaking exclusively to Bloomberg, the co-CEO Joseph Bai discussed their investment strategy in the country and their expectations for new Prime Minister Takaichi.
I think the key in Japan is really the continuity of the policy, really starting with Abe, right? We've had a number of prime ministers since then, but each of these successive prime ministers has continued and expanded the reform agenda here in Japan. And our hope and expectation is this new prime minister will be committed to that same reform path. If that happens, I think the future is very, very bright for Japan.
What's the plan then, Joe? What's the plan for Japan? What is the strategy? How do you grow your foothold in that important market for you?
Well, there's an evolving marketplace here, right? So traditional private equity focused on corporate carve-outs will be our bread and butter. We're seeing more and more activity there. You're seeing more secondary transactions, more public to privates. So I think that speaks to how the private equity industry is maturing here. And beyond that, it's the emergence of new asset classes. So infrastructure investing in Japan is starting to pick up. The need for data centers and digital infrastructure is a really attractive theme. Energy in Japan is a critical issue for the Japanese economy. That's going to take a lot of capital and a lot of private capital to support that. You're also starting to see the emergence of private credit in this marketplace to partner and complement what the Japanese banks are doing. It's going to provide more risk capital and more sources of capital to Japanese companies and entrepreneurs. So there are a lot of different ways to scale our platform here in the market. And most recently, it's around insurance. We have a very large insurance platform called Global Atlantic. We are partnering with Japanese insurance companies to bring them solutions for their policyholders.
You talked about private credit, private equity, you talked about infrastructure. India comes to mind as well. This is one market that has enormous potential. How are you looking at the Indian market? They say that it is coming of age right now.
Yeah, India is an amazing country to invest in. After Japan, India is our second largest destination of investment in Asia. It's underpinned, I think, but by what everybody knows, 1.4 billion people, an incredible demographic story, an incredible consumption story. And you start layering on top of that, more recently, a manufacturing industry that's starting to blossom as well.
And what's the plan for infrastructure in India in particular? We know that this is a growing business for you. In fact, if you take a look at the numbers, it's grown from 13 billion in 2018 to 60 billion right now. And your Asia Infrastructure Fund has been looking to deploy capital, and India could be the biggest beneficiary. It sheds some light on the plan there.
Sure. I mean, India for us is a big destination for both private equity investments as well as infrastructure investments. Our Asian Private Equity Fund and our Asian Infrastructure Fund are the two largest vehicles in their asset classes in the region today, and India is a core destination. So already today in India, we've invested behind toll roads, transmission grids, renewable energy, and digital infrastructure. So I think we're just getting started, but it's going to be one of the largest destinations for infrastructure capital going forward.
KKR co-CEO Joseph Bay speaking exclusively with Bloomberg Insight anchor Haslinda Amin. Now, we are watching, of course, gold miners in Australia that are coming under immense pressure. That's the drag you're seeing on the ASX 200. Futures in Japan pointing to upside, I should say. Markets open in Seoul and Tokyo next. This is Bloomberg. This is the Asia trade. We're counting down to Asia's major market opens. And Bell, never far from our minds, the geopolitical backdrop. We did have the likes of Trump casting doubt about the potential meetings with the leaders of China and Russia, but also watching the price movement in gold after its steepest decline, along with silver, in a really long time.
Yeah, more than a decade, actually, that drop we saw in gold overnight. And it's really that story. We've seen such a big run up. Maybe it was just time for some sort of price correction. Investors also looking to take profit. But you're certainly seeing that really playing across trading sentiment today, because you've got the ASX 200 metals index, for instance, slumping more than 3% this morning so far.
Yep, that positioning risk that our strategists had been warning about, I guess, coming to bear at the moment. Take a look at how Japan is faring at the start of trade, because, of course, we have seen Japan, in terms of the parliamentary vote election of its first female prime minister, watching to see how this impacts economic and foreign policy. A key thing to keep an eye on, of course, is how she not only deals with the cost of living pressures back home, but how she engages with the Trump administration. And of course, she has been appointing party rivals to cabinet positions in order to sort of secure her leadership. For the moment, in Japan, stocks is looking pretty flat, and we are hovering near the 152 handle on the dollar against the yen. And 10-year also keeping an eye, of course, on Japan, whether there's going to be more expansionary fiscal policy from the Takaichi administration. Taking a look as well at South Korean assets. We, of course, yesterday saw, along with Japan, South Korean assets rallying to record highs, something to keep an eye on in the session, looking pretty flat following on from Wall Street's performance overnight. Again, that buyer exhaustion, the risk rally, taking a bit of a breather. But don't forget, we also have the BOK decision that is due tomorrow. And given how the housing market is, the expectation is that it'll leave rates unchanged. Also keeping an eye on what we're seeing on dollar Korea won, and that 14.30 level still looking pretty weak on the local currency bill.
Yeah, and also taking a look at the moves that we're seeing this morning over in Sydney, because it's really standing out to us, this huge slump that we're seeing in precious metal stocks across the board. You can see that the ASX 200 materials index down nearly 3.5% or around 3.5%. So gold and silver was the really big market story overnight. And as we were speaking with Mark Cranfield, for instance, earlier from our MLife team, this was a run-up that was just so sharp and so linear that maybe this kind of move isn't sort of surprising. But still, we're going to be tracking that market reaction. There's another name that we're watching also in Japan this morning, Sumitomo Metal Mining Co. as well. But that stock yet to start trading. So we'll have that when it opens. But let's shift and take a look at what's happening in treasuries, because as we've been discussing, when you have that big correction, that pullback you see in gold, investors still want to see those havens, and they could be flocking into treasuries as well. And that's sort of the price activity as well that we saw yesterday in the session. Moves across the curve, but particularly we were watching them at the long end. So the 30-year yield, that actually reached the lowest level that we've seen going back to April this year. And we've seen similar moves as well in other global bond markets, the UK, Canadian bonds as well. S&P 500 futures, look, they're flat. That it really is the same sort of direction we saw into the close on Tuesday for the US benchmark there. And gold spot, of course, we're continuing to track that and back down closer, a lot closer to that 4,000 an ounce mark.
Yeah, which makes that 4,900 call from some strategists quite far away for the moment. Let's bring in Hartmut Issel. He is head of APAC Equities and Credit at UBS Wealth Management. So, Hartmut, I'm not sure how much of what Bell was running through you caught, but what's interesting in the markets was how this so-called everything rally reversed overnight. Treasuries still catching a bid, though. How are you reading what we're seeing cross assets, particularly as it pertains to the run-up in gold?
Yeah, I take a step back. Usually what we look at is where do rates go, where do yields go, right? And there it's very clear, right? For the largest economy on the planet, so the US economy, that over the next couple of months or quarters is coming down. So you need to also bear that in mind when we look at the asset classes. So how does that place us? Right, we think it places us on the bond side in a good spot for the high-grade government bonds, etc. We also think that for the equity side, right, and I'm also aware that especially for the US part, it's oftentimes a discussion now, is the valuation a bit on the high side, but it's also a bit difficult to see, well, if especially also the bond yields come down further, which is also our expectations, right, why would the valuations come down a lot, right? And at the same time, the earnings, we keep raising them, right? Especially on the AI side, but it's more not only about AI, right? So there's another big sector in the US, which is financials, right? Where you also see double-digit growth. So it's a bit difficult to argue that it shouldn't be in this place. So we have also, for example, on the US market, an attractive view, but the same is true also for global equities.
When you talk about financials, obviously, not so long ago, there was a really strong concern surrounding the regional lenders. What are you seeing now? Have we already moved past that?
Yeah. It is true. It's something we're certainly watching, although it seems to be more isolated cases in any case, because what we're looking at is really also, over many years, especially after the financial crisis, right, how the ROEs of the banks, and not only in the US, right, we're also looking at Europe, how these ROEs have come up. And we do think over the next 2 years, they go up further. We expect they could well go to 12%, but it's something we haven't seen in a long time. And this is ultimately, in our view, the main driver here also for the banking trade in particular. So we opened a new theme on this, quite interesting to look at.
You talked about how, treasuries could be benefiting as a play. What are you seeing, though, on the concerns in the longer end? Has that also gone away? And how does that balance out with what we're seeing in terms of the lack of data, even though we're expecting US CPIs? How does that affect the curve?
Yeah, no, we do certainly see that even for the longer run, right, the rates should come down a bit. I mean, we are looking at an economy that certainly is not going into recession, but is moving a bit slower. So it would be a bit difficult to see why should, especially also on the long run, why should rates really actually rise a lot from here? Not something we have in mind.
How do you play that in Asia? What does that mean for what looks attractive to you?
Yeah. So certainly some of the economies, when you also look at, again, I'm coming back to financials to some extent, but where they are highly listed or in big portions, things like India, also Indonesia, right? I know there's a bit of discussion around it, but it's actually on levels, and especially with almost 60% weight in banks, right? That looks quite interesting right now. But we also have other interesting ones. China Tech, I should mention, so it's not really so much rates related, but very, very clearly, right, where we do see the governments now being fully behind AI, but also maybe pulling down a bit the reliance on US chips, etc. So there's a very, very interesting opportunity also here on the China tech side, and China in general, I should say. So actually across APEC, we have quite a number of areas we like a lot.
On Chinese tech, you talk about this need for self-sufficiency. How much do you think the current plenum follow-through is going to affect Chinese equities outlook, especially as we see that valuation risk? Is that something you're putting in the calculus?
Well, some of what I would also expect, or we would expect from the plenum, is probably already known to some extent, right? So basically, look at R&D and all these things, right? Of course, if you want self-sufficiency, you need to bring up the research side, etc. There's already to some degree happening, but I'm certainly convinced that this will be reiterated at the plenum, and it's very, very clear, right? This trend is not reversing.
I've got to ask you as well, when it comes to the Federal Reserve, the expectations are the continued cuts, as you alluded to a short while ago. We are seeing some of these, I guess, knock-on effects in the dollar and what we're seeing in the Japanese currency. When you look at Japanese stocks overall and how far they've run up, where do you see this going, especially with the current administration?
Yeah. Japan is an interesting case, right? So we went more positive even before the election already, right? So we saw a bit sort of the writing on the wall that actually no matter which candidate ultimately makes it, right, we couldn't really figure out any negative sides of it, right? So either a bit more neutral or up. So it seems that the latter has, from a stock market point of view, the latter has developed, so that's positive, right? But I would go beyond that. I would say in terms of ROEs, for example, right? This has already happened a couple of years back, right? That Japan was, and now it's many Asian markets actually, right? Call it value up, call it some other areas where the governments, the administrations also try to help the stock markets in a different way, right? But Japan was arguably one of the first ones, right? And now if we look very recently, we see the ROEs actually coming up, where we can see it in the data. And that, I think, in the longer run is really the argument to say, hey, Japan, there is something happening and it will last a couple of years. That's a longer period. Need to be in there.
Okay, continued beneficiary of the Value Up program that,
Correct.
of course, we haven't just seen in Japan, South Korea as well.
Exactly. And Singapore.
And Singapore, that is true. Hartmut, great to chat. Thanks so much. Hartmut Issel is head of APEC Equities and Credit at UBS Wealth Management. Belle?
Thanks, Avril. Yeah, taking a look at as well the movers in the session so far, because we are just under 10 minutes into the session for Tokyo, and you're already seeing a big drop here. This is Sumitomo Metal. It is related, of course, to the gold and silver story. And just to recap the big headlines on that front, we saw very sharp sell-offs in gold and silver prices overnight, and investors maybe looking to take some profit and a bit concerned maybe about the huge run-up as well. Lots of retail participation, for instance, have been driving prices of late. But you can see there the gold spot under pressure, down 2.3%. Let's also take a look at another story, because we're still continuing to have earnings season underway. Another name we tracked in the US session was Texas Instruments. That is the biggest maker of analog chips, but essentially we got a pretty lackluster forecast for the current quarter. So they're looking at revenue of $4.22 up to $4.58 billion in the fourth quarter. Analysts have been expecting $4.5 billion on average, and also projected earnings per share undershot expectations from Wall Street. So we are just looking at some Texas Instruments peers here in Japan today. And again, you can see that weakness. There are concerns that the recovery in the semiconductor industry could be sort of slowing down somewhat. But we'll get more on that just ahead. This is Bloomberg.
watching the Asia trade. Now, Sanae Takaichi has become Japan's first female prime minister, securing a parliamentary vote after weeks of negotiation with opposition parties to form a coalition. The Asia Trade co-anchor Shery takes a closer look at Japan's new leader and the challenges ahead.
Elected as head of the ruling Liberal Democratic Party in early October, Sanae Takaichi was a protege of the late Prime Minister Shinzo Abe. Seen as politically right-wing, a supporter of fiscal stimulus and a foreign policy hawk, she has touted conservative values on issues such as women's rights. Offstage, she's known to play the drums and for being a fan of heavy metal music and Margaret Thatcher. Her LDP leadership got off to a rocky start after coalition partner Komeito quit the 26-year alliance, forcing Takaichi to strike a deal with the Japan Innovation Party, the third largest bloc in the lower house. Even with this new coalition, challenges loom. Takaichi must reunite the party and re-engage with voters flocking to smaller populist groups. Japan is also grappling with rising costs of living and challenges with its migrant population.
There is a concern over the Japanese people with too much concentration of the foreign people in certain areas.
Markets are embracing the so-called Takaichi trade, pricing in larger fiscal deficits and heavier JGB issuance. Takaichi is expected to meet with President Trump in the coming days and attend both the APEC and the ASEAN summits in Asia. As she steps onto the world stage while also facing daunting domestic challenges, the focus will be on how she handles the pressure. Shery, Bloomberg, Tokyo.
For more, we're joined by Bloomberg Opinion columnist Garode Reedy. He says Takaichi's fondness for heavy metal music gives clues to how she may lead. I love this connection that you're making, so draw it out for us. And I think at least we can say we know that she likes playing the drums to relieve stress. I'm sure she's had a lot to want to pick the sticks up on in the last 10 days.
Well, actually, to your point there, Takaichi herself says or has said in the past that she does not get stress from work. She says that all of her stress comes from her domestic responsibilities. But obviously, she's in a bit of a bigger role now. So let's see how she handles that. Yeah, so I'm trying to draw the line here between her choice in music and her way of conducting herself. The football manager, Jurgen Klopp, one of the most successful football managers of the past decade, he described his way of playing football, this high-intensity, high-pressure game of football, as a heavy metal football. So I'm attempting to coin heavy metal politics as the way that Takaichi will do things. High-intensity, high-pressure, and we saw that with her willingness to take risk in order to become Prime Minister in the first place, allowing longtime coalition partner Komeito, as was mentioned there in Shery piece, to leave the coalition and to join a new risky coalition with Issel. That is maybe a sign of some of the risk-taking and some of the bold choices that we'll see her taking now that she has the top job.
How might this inform as well, not just how she engages with opposition parties or party rivals, but with the U.S. president, because that meeting might be among the immediate priorities for her next week?
Yes, it's certainly quite unusual, I think, for a Japanese prime minister to become, prime minister, and within less than a week, I think she will probably be meeting with President Trump, and obviously at a time of some tension. There's a lot of not too much tension on the surface, shall we say, but obviously there's still a lot of things to work out with the trade deal that was agreed earlier with the Ishiba administration. So far, I think the signs are pretty positive. Unfortunately, Takaichi, to the best of my knowledge, does not play golf, unlike her mentor, the late Shinzo Abe, who obviously struck a great relationship with President Trump on the golf course. But I do think that they'll probably have a lot in common. The president is known to like, characters, I think, like Takaichi will be, and people who profess to be patriots as she does. So I don't envision too much immediate tension there, but obviously there is a lot to hammer out with the trade deal that the previous government signed on to. I think one good sign that we saw in that is that Takaichi has retained the services of the minister in charge of signing that trade deal, Ryosei Akazawa, who is now going to be in charge of the trade ministry, so she'll be able to lean on his knowledge of that deal.
Another immediate challenge is also going to be quelling some concerns around cost of living crisis, for instance, just inflation generally. Sticking with that idea of her love for the drums, do you think that that's something that can help endear her to voters in any way?
I do think she has two challenges, as you say. So the first one has to be tackling inflation, and she said as much herself at her first press conference last night, where I thought she conducted herself quite well. She shied away from any suggestions of controversial areas. Came off as being very pragmatic. I think that's one fear that maybe some sections have. Is she going to go down some of her more nationalistic, shall we say, tendencies? She kept all of that in check anyway last night, but she does need to do something. She needs to be seen to be doing something to tackle inflation, and especially tackling inflation at the checkout. Food inflation is the big thing that is stressing voters out, shall we say. She has said that's going to be her top priority. Let's see how much she can actually get done. Ishiba was also attempting to tackle it, didn't really get much done in the end. Talked a lot about these cash handouts that are now not going to happen. Takaichi is now going to compile an extra budget, and top line item in that budget has to be something that is going to that households are going to be able to feel, that is going to help them feel better about the inflation that Japan is undergoing.
Yeah, and to some, this also means that we could see a sort of rollback of Japan's fuel tax, something we'll be keeping tabs on. Gerard, great to get your insights, and a great piece as well that you can read all about on the Terminal. Bloomberg Opinion columnist Gerard ready for us there. And let's take a look at how assets are faring in Japan across the board. We are seeing slight pickup when it comes to JGBs, but you're still seeing that 167 below that 167 handle on the yield on the 10-year. And of course, when it comes to inflation fighting, I suppose the weakness of the yen could exacerbate import inflation. So how does this present a potential challenge for the Takaichi administration? And in terms of the stock market performance, there's a big drag we're seeing in the form of SoftBank on the Nikkei bell.
Yeah, that's right. If you take a look at how it's going intraday, it's a very sharp loss for SoftBank so far, down more than or nearly 9%. We're still searching for the exact reason for that, but we will bring it to you if we learn it here. In terms of that drop, I mean, you're looking at the biggest one we've seen since April of this year. But the other big company we're watching is Sumitomo Metal Mining today, and that's after we saw, again, those steep losses in silver and gold. And across the precious metals complex this morning, it is a drag on Asian equities. So we'll have a lot more on all of this ahead. You're watching the Asia trade, and this is Bloomberg. CFO says the company is the CPU of choice in major AI projects from NVIDIA to Oracle. Jason Child also told us that today's AI challenge is supply, not demand, and expects both failures and winners to emerge in the AI space.
If you back up Stargate, I think they said it was going to be something like $500 billion of total spend over 4 years. As of today, we are the CPU of choice. So if you think of, say, Grace Blackwell, or even in the future, Vera Rubin, Grace and Vera, those are both built on ARM from NVIDIA. And then, of course, to the extent that Oracle's also going to be contributing, that's certainly another partner that we could be helping. And then there's OpenAI, and certainly there's, I guess, rumors of custom efforts by them. And for the most part, most of the custom efforts, there's been a lot of discussion about using ARM based CPUs to pair with those custom GPUs. So a lot of opportunity, and it could be significant.
The numbers, I mean, you mentioned 500 billion.
Yeah.
The numbers are kind of range from 100 billion to 500 billion.
Yeah.
Is there a risk that the revenues realised won't match some of those larger aims and larger aspirations?
Possibly. We're not super close to the total spend in Stargate, but if you look at what the needs and uses are right now of AI, compute in particular, supply is far behind demand. And so at this point, I think the challenge is really just about, can you get the power, can you get the chips, and can you get the systems deployed? And so, with that kind of a demand cycle, I expect there's a decent chance that you'll see us at the high end of that.
So on that point about supply not meeting demand right now, we've seen these incredible numbers, incredible deals across the infrastructure space from the hyperscalers and OpenAI and many others. On a promised future, but not fully realised yet, does it concern you? I mean, are we seeing an AI bubble?
Okay, so when I think about bubbles, I think about, I was actually at Amazon back in 99, 2000, when things were getting frothy, I think they said. What was interesting there is there was a bunch of build-out, but a lot of that build-out wasn't really being deployed, or it wasn't being fully utilized. If you think about all the servers, all the websites, the shipping capacity, et cetera. What's different in this cycle is the problem we have right now is supply, not demand. That was really more of a demand issue. This is really, right now, our challenge is supply. So I think the question is going to be, is there going to be a situation where you have a bunch of companies that probably have raised capital and maybe are pre-revenue? Is there a bunch of those companies that maybe won't make it out? So are they going to be the Pets.com or Home Grocer or Webvan or whatever? Sure, that certainly could happen. But are there also going to be the equivalents of Amazon, Google, eBay, Yahoo, these other companies that actually were, quite large and became, pretty huge companies? I expect that to happen as well. So how we define bubble and who's the winners and losers, I think that's all to be seen.
CFO Jason Child speaking to Bloomberg's Tom McKenzie. Let's take a look as well at how Europe futures are faring. Of course, overnight we did see stocks climbing. France hit a record on the CAC 40, and this is against the backdrop of the focus on earnings. For the moment, futures pointing to that downside. Across the board, we have been seeing those concerns about the risk rally going too far. We have more ahead on the Asia trade. This is Bloomberg.
Right now, as of November 1st, China will have about 155% tariff put on it. And I don't think it's sustainable for them, so I want to be nice to China. But China's been very rough with us over the years.
Well, President Trump says an upcoming meeting with his Chinese counterpart Xi Jinping would yield a good deal on trade, while also conceding that the highly anticipated talks may not happen. Let's bring in our China correspondent, Min Min Lo. And Min Min, we've seen really a lot of flip-flopping from President Trump as on his tone for this, but in the latest iteration, he is still saying it can be a successful one.
Yes, Val, you know what? I am not sure we should be paying so much attention to what President Trump says from day to day because, like you said, it's a lot of mixed messages every day, and these messages seem to sort of expire within a day or two. But the latest iteration he's saying is that he is threatening these tariffs as high as 155% starting from November 1st. And he is saying that, yes, he's expecting a very successful meeting with President Xi because those high tariffs are not going to be sustainable for China. But at the same time, he's also leaving room for this meeting to not happen, saying that somebody might decide not to meet because it's going to be nasty. And the signal here suggests that he wants the meeting to happen, that any cancellation will be from the Chinese part. But so far, China has been keeping mum on the state of this potential talks between the two sides. But so far, all signals point to very concrete steps that are being taken to pave the way for those talks. Scott Bessent is meeting with his Chinese counterpart this weekend to de-escalate trade tensions. The two men had already had a virtual call last Friday, which the Chinese side had said was frank and constructive. So yes, perhaps in a couple of weeks' time, we might see the two leaders meeting. What they would discuss and what is the outcome of that talk, that remains to be seen, of course.
Min, what about discussions with European leaders? I suppose something that's on your radar is also how Beijing is warning the Dutch government that a seizure of Chinese chips firms that could be affecting the stability of the global supply chain.
Yes, this is another sign of how other countries, like the Dutch government, they are now being dragged into the US-China trade war because the Dutch government has seized control of a Chinese tech chip firm called Nexperia. They did that and removed the CEO, the Chinese CEO, placed the CFO in charge. That was after the US expanded the rules of its entity list to include not just the companies on the list, but also its subsidiaries as well. And Nexperia is a subsidiary of a Chinese firm called Wingtech. And in retaliation, China has now said it's placing export controls on Nexperia, which means that the company that is in Netherlands will no longer be able to export products that comes from its Chinese factory. And again, China is warning the Netherlands, saying that this could disrupt supply chain, and already sources are saying that because this company produces mature chips for the auto industry, the consumer electronics industry, suppliers are going to feel the impact within a week, and that impact could be felt across the sector in 10 to 20 days. That's according to sources. So time is of the essence here, and both sides are aware of that. They are having, frequent talks, and I guess they're looking towards a solution. And China is urging the Dutch government to undo those measures.
Min, thank you so much. Bloomberg's China correspondent Min Lo for us there. And of course, we'll be watching in the session as well, against the backdrop of these sharp moves in gold prices, how this affects miners, not just in Australia, but in China as well. When markets open, for the moment, you are seeing the likes of Sun Silver also coming under immense pressure amid those steep declines in both gold and silver prices overnight. Now, on top of that, does this have more to go? If you take a look at some of our strategists' commentary on the MLive blog, they think that gold has further to fall in a sort of catch down with Bitcoin. Don't forget, risk had been rallying along with the precious metal. So there is a lot of positioning unwinding against that backdrop. Now let's bring in Bloomberg's Asia Energy and Commodities editor, Andrew James, for more on the moves that we've been seeing in gold. Andrew, so gold has been coming off. It seems like a bit of that consolidation, perhaps not unexpected. What is your sense of where things go from here?
Hi, Avril. Yeah, well, I think we need to put this into the context of the really scorching rally that gold has had since mid-August. I mean, precious metals have been rallying broadly for a couple of years now, but the latest leg upwards sort of started in mid-August, and they've climbed very, very rapidly. And, I mean, over the last week or so, technical indicators have sort of suggested that rally was overdone, and I think that's what we're seeing now. We're seeing a bit of a pullback, a bit of profit-taking. But I would say a lot of the factors that have been driving gold and silver higher are still there. So I wouldn't expect, they might fall a bit further, but I don't think I'd expect a major drop in for gold and silver to sort of erase that sort of latest leg of the rally that's been going since mid-August.
Talk to us about those drivers a bit more, because we are seeing that in the form of both, I guess, political uncertainty in the US and geopolitical uncertainty more broadly.
Yeah, that's right. There's been a lot of talk in the last month or two about the so-called debasement trade, which is when people get very nervous about, high debt levels at governments, and they start losing faith in traditional assets like government bonds and currencies. That's definitely been a factor. There's anxiety about the US dollar, what's going to happen to that. That's also drove sort of investment into gold. We've had big central bank purchases. We've also had a bit of a retail ETF type frenzy with people wanting to get in on the rally. Then we've also got the prospect of the Federal Reserve continuing to cut interest rates. So, I mean, all that has fed into demand for precious metals. In the silver market, it was exacerbated by a big sort of short squeeze in London last week where people couldn't get hold of metal, and the silver market is a lot less liquid than the gold market. So that is partially the reason for what happened there.
In commodities, also interesting what we're seeing across assets, particularly in oil prices. Obviously, there is a demand issue there, but near term, what are you seeing in terms of the drivers? There's been talk about how we're seeing the change in U.S. inventories, and along with that, the U.S. refilling its strategic petroleum reserves as oil prices come under pressure.
Yeah, well, I mean, oil prices have obviously been under pressure, and a lot of that is to do with OPEC sort of reversing its position and deciding to open the taps a bit and reclaim a bit of market share. Underlying all this is the demand picture with, you know, what President Trump's moves on global trade and how that's going to affect economic growth. So it's not a particularly positive picture on that front. I think the big factor is does OPEC reverse its position if prices get too low and start sort of restricting pumping of barrels again? That's probably the main factor that might reverse this current slump in oil prices.
Andrew, thanks so much for the latest on what we're seeing in commodities moves. Of course, along with oil prices coming under pressure, also the decline in gold and silver prices that we are watching in the session. Asia Energy and Commodities editor Andrew Janes for us. We'll have more ahead on the Asia trade. This is Bloomberg. Let's take a look at how Asia benchmarks are faring. Of course, after those record highs we saw on Japanese and South Korean stocks just a day ago, you are seeing that reversal for the moment. The Nikkei down 1.2% from those recent highs, and this is against the backdrop of concerns that the semiconductor industry recovery could be sputtering. Of course, we did hear from the likes of Texas Instruments, and its forecast for the current period did look pretty lackluster. So that might be playing out in some of the chip-related stocks in the Asia Pacific. South Korea also down a touch. And in terms of what we're seeing in Australia, it's still the miners that are the biggest drag on the benchmark there, including both the silver and gold related stocks. The region's benchmark, which just a day ago was climbing along with Wall Street, is also taking a breather. Now, as we keep tabs on the Japanese stock market performance, we've also been hearing from New York-based buyout giant KKR. It says global investors with heavy U.S. exposure are steadily shifting more capital to Asia as the dollar loses steam and the region's fundamentals shine. The company has also been ramping up in Japan, which is now their most active investment destination outside the U.S. Co-CEO Joseph Bay spoke to us exclusively about their strategy and their expectations for new Prime Minister Sanae Takaichi.
I think the key in Japan is really the continuity of the policy, really starting with Abe, right? We've had a number of prime ministers since then, but each of these successive prime ministers has continued and expanded the reform agenda here in Japan. And our hope and expectation is this new prime minister will be committed to that same reform path. If that happens, I think the future is very, very bright for Japan.
What's the plan then, Joe? What's the plan for Japan? What is the strategy? How do you grow your foothold in that important market for you?
Well, there's an evolving marketplace here, right? So traditional private equity focused on corporate carve-outs will be our bread and butter. We're seeing more and more activity there. You're seeing more secondary transactions, more public to privates. So I think that speaks to how the private equity industry is maturing here. And beyond that, it's the emergence of new asset classes. So infrastructure investing in Japan is starting to pick up. The need for data centers and digital infrastructure is a really attractive theme. Energy in Japan is a critical issue for the Japanese economy. That's going to take a lot of capital and a lot of private capital to support that. You're also starting to see the emergence of private credit in this marketplace to partner and complement what the Japanese banks are doing. It's going to provide more risk capital and more sources of capital to Japanese companies and entrepreneurs. So there are a lot of different ways to scale our platform here in the market. And most recently, it's around insurance. We have a very large insurance platform called Global Atlantic. We are partnering with Japanese insurance companies to bring them solutions for their policyholders.
You talked about private credit, private equity, you talked about infrastructure. India comes to mind as well. This is one market that has enormous potential. How are you looking at the Indian market? They say that it is coming of age right now.
Yeah, India is an amazing country to invest in. After Japan, India is our second largest destination of investment in Asia. It's underpinned, I think, but by what everybody knows, 1.4 billion people, an incredible demographic story, an incredible consumption story. And you start layering on top of that, more recently, a manufacturing industry that's starting to blossom as well.
And what's the plan for infrastructure in India in particular? We know that this is a growing business for you. In fact, if you take a look at the numbers, it's grown from 13 billion in 2018 to 60 billion right now. And your Asia Infrastructure Fund has been looking to deploy capital, and India could be the biggest beneficiary. It sheds some light on the plan there.
Sure. I mean, India for us is a big destination for both private equity investments as well as infrastructure investments. Our Asian Private Equity Fund and our Asian Infrastructure Fund are the two largest vehicles in their asset classes in the region today, and India is a core destination. So already today in India, we've invested behind toll roads, transmission grids, renewable energy, and digital infrastructure. So I think we're just getting started, but it's going to be one of the largest destinations for infrastructure capital going forward.
It is hard to talk about Asia without looking at China. This is a huge market, but we know that when it comes to top PE companies, they've pretty much put a break on, investing in the deals in China. What's your take on the environment there?
Yeah, given the current geopolitical climate, certainly the aperture of what's investable for us today is a little bit more narrow than what it was 5 years ago or 10 years ago. Our approach, though, is we have definitely not pulled back from the China market in terms of our commitment there. We just need to be much more tailored in terms of the sectors and the themes that we think are investable. Our focus really for the last 20 years in China has been focused on domestic consumption and value-added services, which we think is a sweet spot of the Chinese economy, actually. Just recently, we announced one of the largest control buyouts in China in the largest domestic branded soft drinks business, over a $2 billion transaction. So if it's in that sweet spot of domestic consumption, local champions, we're very, very excited to invest in China today.
Are you seeing signs of M&A revival? And what do you think it will take to see a real reversal in sentiment when it comes to the Chinese market?
I think the biggest catalyst, positive catalyst for Chinese private equity, the industry, would be a clearer path to liquidity, to monetization. The stock markets need to open up so investors can exit their positions more easily. And the M&A market needs to continue to expand. It's going to be more probably sponsor to sponsor in the next 3 to 5 years. The strategic bid from international companies is probably not going to come back as quickly in China. But as the Chinese stock market improves, that path to liquidity, I think, is going to be critical for investors.
Joe, let's take a look at some of the macro trends happening today. We've been talking a lot about de-dollarization, how investors are pulling back from the USD. Do you see that? There is a debate. Where do you stand on the issue?
Yeah, I don't think it's a question of global investors exiting the U.S. market by any means. I think it's more a question of diversifying their portfolios with that incremental dollar. Where do you want to invest it? I do think it's fair to say that most global investors have a lot of exposure to the U.S. right now. And as the U.S. dollar weakens and other markets like Asia continue to have these fundamental tailwinds in terms of growth, I think you're going to see people diversify their portfolios more and more to Asia over time. And that makes sense in a multipolar world, right? As regional economies are becoming more important, as Asia is getting more dependent on intra-Asia trade and growth, I think you're going to see more and more capital flow to Asia. It doesn't mean they're pulling out of the US, though.
But do you see that getting momentum then, Joe?
I think it really depends on who you are and what your portfolio looks like today. You know, there are clearly some investors that probably have really very large exposures to the US, maybe a lot of tech exposure to the US, and are looking to diversify. There are lots of investors in the US that have very small allocations to Asia today. And I think that's going to start shifting as well with the incremental dollar of investment. They want diversification. They want access to the growth that people are seeing in Asia. And I think you're going to see more and more capital flow to this part of the world.
That was the KKR co-CEO Joseph Bay speaking exclusively with Bloomberg Insight anchor Haslinder Min, and we'll have more ahead on the Asia trade. This is Bloomberg. Top corporate stories that we're tracking this morning. L'Oreal ADRs fell after disappointing sales growth in the last quarter as weakness in the US outweighed signs of improvement in China. A pickup in demand for high-end beauty products in mainland China helped lift sales by 4.2%, but analysts had expected a gain of almost 5%. Pop Mart posted strong revenue growth in the third quarter, driven by its popular Labubu dolls. Sales jumped as much as 250% from a year earlier. The company launched new mini Labubus in late August, which sparked a fresh buying frenzy, and sales in overseas markets surged 370% compared to around 190% growth in mainland China.
Yeah, we'll watch for how China markets open, but we are seeing the likes of Goldman talking about this 30% upside potential through to 2027 for Chinese stocks as it sees the potential for profit growth coming up. And of course, we're also going to be watching how gold miners fare in the session, given these big moves you're seeing in the precious metal. For more on what to watch as we count down to the open, let's bring Bloomberg Executive Editor for Asia Markets, Paul Dobson. Nice to see you, Paul.
Hi, morning.
We are seeing that steep sell-off in gold and silver.
Yeah.
Do you think this exists in a sort of vacuum? Will there be a bit of a broader contagion effect?
So I think that that's the next thing market watchers will be looking out for, because the moves in gold and silver have been so extreme. The question is whether this has been powered by a lot of leverage trades. And if so, if we start to get margin calls, and if that means that investors have to liquidate other assets in order to realize the cash to meet those margin payments. So that's the risk, you know, and we could see it across a lot of different asset classes that have all been moving in similar kind of momentum ways to gold and silver on the way up. Now kind of pulling back. We see it in crypto as well. Tech stocks are looking a little bit wobbly this morning too. And so, you know, that's one way that this could kind of magnify and ripple across broader markets from where we are at the moment.
Yeah, it's really hard, I guess, in that sense to understand where gold sits. Are you talking about as a haven? Are you talking about as a risk asset? What exactly, how exactly are you framing it right now, do you think?
I think definitely to call it a haven is a little bit of a misnomer, given the rally that we've seen. We've seen it going up on days when stocks have gone down. We've seen it going up on days when stocks have gone up as well. So clearly that's not what people have been buying it for uniquely. Maybe there's some part of that, but there's also, you know, the pervasive mistrust of financial markets and financial systems in general. We've got the central bank buying. We've got the retail and domestic demand. And one of the reasons maybe that we're seeing a big fall-off at the moment is because of the Diwali holiday in India, which is sucking a little bit of that demand out of the market. But then we also have seen the momentum traders jumping on board, you know, loving the fact that the market has been going so strong and in overbought territory for so long. It did feel like at some point we were going to sort of run out of road. And the drop-off from the cliff, you know, as we've seen as a result of that sort of exhaustion from the buyer side has been pretty dramatic. And we're into a much more volatile and choppy trading period now.
So how does all this fit in with global markets then?
So I think we'll see. You know, part of the reasons that people might want to have owned precious metals is the idea that the central banks are going to start cutting interest rates. That's being priced in. We're seeing the Treasury yields continue to fall. The 10-year yield below 4% still. We're seeing markets really on edge at the moment, and I think that the big volatility that we're seeing in precious metals is kind of symptomatic of that as well. You know, equities have had a really good run. Can they continue going with the trade talks in the background between Trump and Xi being a really big kind of unknown, basically? You know, could go either way, right? Trump was saying just as much as that overnight as well. The market is hopeful at the moment and priced probably for a favourable outcome. But if that does blow up, then we could turn tail and have a pretty big risk-off move pretty quickly as well.
Paul, great to have you setting us up for the session. Bloomberg Executive Editor for Asia Markets, Paul Dobson, here in Singapore with me. That's it from the Asia Trade. Our markets coverage continues as we look ahead to the start of trade in Hong Kong, Shanghai and Shenzhen. The China show is next. This is Bloomberg.